The standard view of the global economy is one of clear roles. The Federal Reserve prints the money, the government manages the crises, and private corporations compete on the open market. This chart compares the world's most dominant financial players. A single firm, BlackRock, manages a staggering $9 trillion in assets, a figure roughly equivalent to 70% of the entire U.S. GDP. This capital gives them a massive ownership footprint. They are top shareholders in tech giants like Apple and Microsoft, while simultaneously holding dominant stakes in competing major banks like Wells Fargo and Chase. This influence extends directly into the public sector. When the federal government needed to manage the economic bailouts of 2008 and 2020, they bypassed public agencies and hired BlackRock to lead the rescue efforts. When a single private entity manages the bailouts of the same corporations it already owns, the traditional distance between the government and the free market disappears. Larry Fink is the architect of this empire. He has spent over 3 decades building BlackRock into a global force while intentionally avoiding the level of public scrutiny typically aimed at the world's most powerful CEOs. It raises a difficult question. How did a relatively unknown executive become the indispensable middleman between Wall Street and Washington? The answer lies in a singular public humiliation that took place decades ago, a catastrophe that redefined his understanding of risk. Fink started on Wall Street at age 23, quickly establishing himself as a young prodigy at the firm First Boston. He rose to become their youngest managing director in history by generating $1 billion for the company's bottom line. Fink helped pioneer debt securitization, taking thousands of individual loans and bundling them into a single tradable investment block. These mortgage-backed securities transformed global finance, but inherently masked the risk of the underlying loans. In 1986, Fink miscalculated a shift in interest rates, and his trades were wiped out overnight. He lost $100 million for his firm. The fallout was immediate. Fink was ostracized by his colleagues and forced out of the company he had helped build, his reputation in the industry seemingly destroyed. This public failure birthed a paranoid obsession with control. Fink vowed he would never again take a financial position where he didn't perfectly understand every hidden variable. In 1988, he co-founded what would become BlackRock. The firm was built as a fortress against the kind of unpredictability that had ended his career at First Boston. To achieve this, he didn't just rely on human traders. He built Aladdin, a proprietary network of 5,000 supercomputers designed to monitor millions of trades 24 hours a day. This map illustrates Aladdin as the central node of the global financial system. It pulls sensitive data from banks, insurance companies, and pension funds, running endless risk scenarios. Aladdin now has a direct eye on 10% of all stocks and bonds worldwide. BlackRock functions as the central nervous system of global finance, processing information at a scale that removes the element of surprise from their investment strategy. During the 2008 financial crisis, the mortgage-backed securities Fink helped pioneer caused a global meltdown. When the government needed to clean up the mess, they turned to the Federal Reserve. Because the Fed lacked the technology to analyze complex debt, they awarded BlackRock secretive, no-bid contracts to manage the bailout. Larry Fink went from being the man whose tools caused the crash to the man paid to fix it. The government returned to BlackRock during the 2020 pandemic. The Fed hired them to manage a massive program buying corporate bonds to prevent another collapse. This created a significant conflict of interest. BlackRock was effectively managing the bailout of the exact same corporations in which they held some of the largest ownership stakes. This loop of circular ownership cemented Fink's role as the indispensable manager of the U.S. economy, a position that placed him beyond the reach of traditional market forces. BlackRock is now using its massive capital to dictate corporate behavior to prevent broad societal risks. This flowchart demonstrates how BlackRock uses ESG scores, which stand for environmental, social, and corporate governance. A low score acts as a gate, physically cutting a corporation off from BlackRock's pool of investment capital. To maintain their scores and keep their stock investable, corporations are forced to adopt specific social and environmental policies dictated by the firm. Larry Fink's obsession with controlling financial risk has resulted in a machine that engineers the corporate landscape to its own specifications. He no longer predicts the future, he builds it.